Well, hello there, everyone. This is Mazske Finance with another special guest who you just saw recently, and you're going to come to love him. And today is Monday, April the 11th of the year 2022. And with that being said, I will turn it over to my special guest, Millennial Mike.
Mark, thanks always for having me on the channel. I appreciate it. Today, we're going to talk about whether or not you can refinance successfully in a rising interest rate environment. So both Mark and I have, well, he has purchased 3 project houses that he plans to use the BRRRR method on currently right now. I have an offer in on one, fingers crossed. But the strategy for the BRRRR method, as most of you know, is to buy it, rehab the property, rent it out, and then refinance it at the new increased value. So for instance, the numbers on my property, I'm buying it for 62 grand, hoping to put 15 into it, and that it'll be worth 100,000 on the back end. At that point, I do a cash out refinance, pay myself most of my money back, and then have a cash flowing rental property. Now, here's the problem. The interest rates, as most people know, because of inflation and the Fed and all the drama that's going on, are going up, and they're going up pretty quickly. And so that really throws a wrench in your ability to accurately calculate what your refinance loan will be on the back end. So my concerns are, well, what if I'm wrong? What if I've calculated this all at a 4% interest rate 6 months from now after the season period has ended? All of a sudden, interest rates are 7% because a bunch of our guys are getting them in the 6% right now. So Mark's going to go ahead and calm my nerves, AKA give us some good advice on what he thinks some contingency plans would be to deal with this situation if it does play out like that. So Mark, I'm all ears. Let me know what you got.
All right, sounds good, buddy. All right, well, a couple things here. As you said, I have 3 houses that I've purchased, and all 3 are currently under rehab. And I do not recommend anybody copy what I'm doing unless you're a veteran real estate investor, because 3 houses under rehab at the same time, number one, takes a lot of cash. And even in myself, that's one of my concerns that I haven't mentioned to Mike is, what if it takes even more cash and all of a sudden Mazske starts running out of cash? That could be a problem. And then I might be saying, hey, Mike, you got any extra money you can loan me? I'm just kidding there.
Yeah, at the friend discount rate. Yeah, I'll beat the Fed. I'll give you a 5% rate.
Right. Yeah, and I'm just being facetious there, but it's like worst case scenario. What if I did run out of money? All right. So anyway, that's my concern, not Mike's concern. So with my 3 houses, if you guys have been watching my channel, Mike and myself did a video a month or so ago where we're talking about using a lender, a non-QM lender called Kiave. And from talking with them at that time, the interest rate they said they would give me was 5.25%. So I ran all of my numbers using a 5.25% interest rate. Okay, but now we're living in an environment where the Fed has raised their rates 0.25, and they're going to raise rates again in June, and they may raise rates potentially a half a point, maybe more, maybe less. They may do an emergency meeting and raise them again. We don't know how high rates will go. Okay, so with my 3 houses, what I did is I had initially run numbers of different ways I had hoped to refinance them. One is currently a bridge loan through Kiave. That's kind of like a hard money loan. The other 2 houses I pay cash with. The cash houses are different. The bridge loan house, I want to get done as quick as I can because I'm paying a higher interest rate because it's kind of like a hard money loan. All right, so, but with all 3 of my houses, if rates did keep going up, all right, what I did, I ran numbers just this morning using a number that will sound familiar to you, Mike, and to perhaps others in our mastermind group. I ran the numbers using an interest rate of 6.75%, because that's what our friend Helicopter Pilot Caleb got on one of his mortgages recently.
Sadly, sadly, that's what we're running them at right now. Yeah.
Yeah. So when I use that number, all I did, that's the only thing I changed was my interest rate just to see how that would affect it. All 3 of my properties would potentially cash flow very, very well at 5.25. At 6.75, they all 3 will cash flow better than my normal expectations. My normal expectations are $250 a month positive cash flow.
Mhm.
And all three would be above that. But what I was playing around with myself was a couple things, because what if rates weren't 6.75, they were 7.25?
Right.
And my initial plans were to try to pull out the maximum amount of cash that I could to get cash back without overextending myself and still having very good positive cash flow. So if rates did go higher, one thing that I would do would look at not pulling all of my cash out. I would leave cash in the deal. And that for three different houses, it could be three different scenarios. I might leave just a little bit in the deal, like maybe I'm putting $5,000 in the deal. Maybe another house, to make the numbers work, I might leave $15,000 in the deal.
And Mark, just so people know, you're talking about $5,000 to $15,000 extra beyond what you would have already had to leave in the deal, because anytime you do a cash out refinance, the lender, traditional lender is only going to let you take out 75% of the value of that house. If it's a $100,000 house, they'll let you borrow 75 grand. So what Mark is saying is, instead of borrowing 75 grand, he may take a loan for 70 grand, or maybe 60 grand, leaving between $5,000 to $15,000 of extra equity in that property. And the reason is because he needs to make sure that his mortgage or his loan is small enough so that his payment is small enough so that the house still cash flows. Did I explain that right, Mark?
Right, you explained it very well.
Okay, back to your point. So I just wanted to jump in, make sure people are following along.
Sure. And because remember, you and I are in different situations. You're working full time. I'm not working, and I'm living off my investments. So to me, I really need to replenish my cash coffers. I need to pull cash out of the deal, but I don't have to pull every penny out. But I do need the cash flow, because that cash flow will contribute to my quality of life here. I need it to improve my lifestyle. I need that cash flow.
Right.
Okay.
Yeah. And so people understand the reason why interest rates are affecting the BRRRR strategy so much. If you're a newbie investor, maybe this is a little high level conversation. The reason interest rates affect the BRRRR strategy is because they affect your ability to get cash flow on the back end. When you're anticipating, all right, if I do a cash out refinance, my monthly payment is going to be this, $300 a month. But if interest rates have doubled, and we were getting 3% last year, and now we're calculating for 6.75%. If interest rates double, or worse, go more than that, it destroys your cash flow. Your monthly payment is now no longer $300 a month, it's $400 a month, or it jumps from $500 to $700. So that destroys your cash flow and could create an alligator property. What Mark's talking about here is, especially because he doesn't have a job anymore, he is living off of his investments full time. He has to make sure that each property is generating cash flow for him monthly. So if you can't fight the interest rates because they're just going to do what they're going to do, the other option is to just leave more money in the deal. Instead of a 25% down payment, you leave a 30, 40, maybe 50% of the equity in the deal. So your payment is smaller, so it still cash flows. Now, this does affect your cash on cash return, but at least it does solve the more immediate problem of allowing him to keep generating cash flow to progress forward with his investments. Mark, back to you for your thoughts.
All right, that sounds good. I love the way you can recap everything and put it into your terms, which if I sit back and watch videos, I might listen to myself and be like, okay, I understand what I'm saying. But when I listen to you, it's like, it clicks. I got it. So you do a great job with that. Not just with me, with anyone you have interviewed, I've seen you do the same thing. And it's extremely helpful, I believe, to myself and all of your viewers. So thank you for doing that.
Thank you. I'm happy to do so. I'm just trying to make sure that I understand it, because you've got the information and I'm going to go take action on it. And I want to make sure I take the right action. So it's in my best interest to make sure I understood it very clearly.
Sounds good. And one thing for yourself and for anyone watching this, all of us are unique individuals. We all have different situations. All right, I have 3 houses I'm getting. If I have to get less cash back, and maybe I'm leaving 50% of the potential mortgage in the deal, and I'm only pulling 50% out, and I could perhaps do that and I'd be okay. And let's just say interest rates shot up to 10% or something.
Mm-hmm.
But if you have a HELOC loan or a hard money loan, you can't leave extra money in the deal because you got to get that cash back to pay your loan off.
Right.
Okay. But I know the way you're doing things. You're buying one house, you have a full-time job, you're going to be okay no matter what. If someone out there tried to copy me and said, hey, I got X number of dollars, I'm going to go get 3 properties, but I need some help from Uncle Joe or Bill down the street. It's going to help me with some private money. Be careful, because if you can't pull all your money out, how are you going to pay those loans off? All
Yeah.
right?
So, for my situation specifically, like you mentioned, I'm using a HELOC. Now, the HELOC has an interest rate on it. The interest rate, not bad, whatever the regular rate that a homeowner would get is of, 3%, then I'm paying like 4.5%. But I'm always going to pay about 1.5% more than what a homeowner is going to get. The problem is that I don't get to lock my rate in. So if I withdraw the $62,000 today, as rates climb, my interest rate on my HELOC climbs, which is not fun. So my holding costs for that loan aren't great. Now, that being said, it's still better than a hard money lender. Hard money lenders are going to be asking you to pay points, probably have a 10% rate. I mean, they're much more expensive. So I'm still beating out a lot of hard money lenders by using my HELOC, but I still want to make sure that I'm not dumping too much money into the project via interest rate payments and loan payments that it really destroys the cash on cash return. And so that's where I want to do that refinance to get my money back. If I do that cash out refinance at the end, I pay all that money off. So the difficult thing is, if I decide to leave some of the money in the deal, like you were just talking about, that $100,000 house, instead of getting 75 grand out of it, I only get 60 grand out of it. Well, I borrowed 70 grand out of my HELOC just to do the project. So now I have a $10,000 leftover amount that I actually have to still pay back the HELOC out of my own pocket. Now, as Mark and I were talking, that's not necessarily a bad thing, because if I was to not use the BRRRR strategy, if I was to not do any of this and instead just go to the MLS, pick a house, use traditional lending, 20% down with a fixed interest rate, usually for me to buy one property would probably cost me between $10,000 to $20,000 out of pocket, which means that ideally with the BRRRR strategy, it costs me $0 out of pocket. I get all my money back. But let's say I don't get all my money back. I have up to that $10,000 to $20,000 of leaving it in the deal before I would just break even with what it would have cost me anyways. Obviously, it took more of my time to remodel the property, and there was the stress and stuff involved there. But on a purely dollar amount, I have up to potentially $20,000 of miscalculating where I would still break even with a regular deal. So that gives me a little bit of wiggle room and comfort knowing that even if it doesn't all operate exactly how I'd like, I'm still going to be just fine. And worst case scenario, if I can't refinance, everything goes to heck, I'll just aggressively pay that HELOC down as fast as I freaking can, because I do have a pretty good W-2 income job, and I would attack it that way. Any other ideas on that, Mark?
Yeah, well, everything you said there makes sense to me, and it sounds good. One thing that I have decided just in the past, I don't know, month or so for myself personally, and I told my wife this also, which means if I told her, we're probably going to stick to it, is that I'm not going to do this again where I buy 3 houses at one time where all 3 need to be rehabbed. Not saying I'll never do it again. I'm not going to do it in this environment. So once I get these 3, once I get the first one done and refinanced, I can breathe deeper because one's done.
Right.
And then I just move to number 2 and number 3 and get them refinanced. But the stress will disappear once I get that first one refinanced. But something I'm thinking about though is get the 3 of these done, watch the market, watch what's happening, watch prices, and watch rents. Because as interest rates go up, rents have already been going up nationwide. But I think they're sort of stabilizing. But if rates start going up, what will happen to rents? Will they also go up, or are they just going to stay where they're at? If they're going to stay where they're at, for you and I both, if we're buying houses for 60 to 70,000, but now rates are that much higher, well, we need to get these houses for a cheaper price, 50 to 55,000. And if we can't do that, well, maybe we we just sit back and wait. Yeah,
we have to take a tactical pause in the situation. I was having a conversation with Darius this morning, and Darius, who's been on your channel, my channel, And he was talking about this house, 3-bedroom, 1-bath, $79,000 house. Now, it's a little bit expensive for what I would buy in Gary, a $79,000 3-bed one. I'd rather see it at 70 grand, but it's especially expensive right now, given the interest rates, because it's going to destroy the cash flow. And he and I were chatting about that. And I was like, look, here's the thing. Other investors are coming up against the exact same problem you are. Everyone's going to be like, it doesn't make sense at this price point, given the interest rate right now. And so all that's going to leave is people who want to buy it cash, who will probably offer significantly under market, or write a low ball offer, because they're not going to get the offer they want from an investor. Most investors are going to look at this property and say, this doesn't cash flow, I can't buy it. They will either get no offers. Maybe they'll get an actual homeowner, home buyer who doesn't care about the cash flow as much, or they're going to get cash offers, which will be low. So I said, run your numbers, figure out what price point it actually cash flows given your interest rates. You know, we want that $250 a month with like at least a 15% cash on cash return. If that number is not 79,000 and instead it's 71,000, write an offer for 71,000, and maybe they accept it. Maybe they're like, we don't care, we're going to get so many other offers. But when they don't, maybe they come back to yours and say, oh, well, all right, if we have to sell, this is the only offer. And if they don't have to sell, they'll probably just pull it off the market, sit around and wait. But don't play their game. You know what your requirements are for a good deal. And like you said, Mark, if we can't find them, and write the low offers, and if they aren't accepted, all right, I guess I'll just wait till the market starts to correct naturally.
Right. I agree. And with all that being said, because I agree with everything you're saying, my youngest son, age 24, just closed on his first rental property like a week and a half ago. He got a mortgage through Prime Lending. It's his first mortgage ever. He has great credit. And as you probably know, as you get more rentals, the interest rate will be a little bit higher. Okay. Mm-hmm. So just a week and a half ago, though, he got 5.125%, which is a pretty decent interest rate.
Not bad.
Right. So even though rates are going up, and even though on YouTube you hear real estate investors talk about the panic, rates are going up, in the big scheme of things, are they really going up that much? We'll see.
Yeah. And the other thing I told him too, when we're buying houses under $100,000, a jump in interest rates from 4 to 6%, is probably only 50, 60 bucks a month. It's not terrible. That being said, I still have my requirements. I still have what I want to get for a deal. And if it doesn't meet my definition of a good or great deal, then I just won't offer on it, or I'll offer low. And I'm confident that eventually a deal will pop up where someone needs to sell, they're motivated to sell, they're willing to work or whatever, and it'll come through. You're right. Interest rates are still historically low. You can look up the interest rates on the day you were born. Well, when I was born in 1990, they were at 10%. But prices were significantly lower back then too. So it's just a game. You need to have a certain level of understanding of the rules of the game. And then as the game is developing in front of you while you're playing, whether that be basketball, football, soccer, I don't know much about baseball, but I know you love it, Mark. But as the game is developing in front of you, you adjust your strategy. In soccer, they have their star player. Well, you put your best defender there, even if he's pulled out of position a little bit. I don't know what you do in baseball when someone's super good, but when I was a kid, if someone could hit the ball really far, you backed the outfield out so they could catch him. You adjust to whatever is happening on the field in front of you, but you don't quit playing the game. At the end of the day, I'm still trying to win. And I know using investments and real estate investments is how I'm going to do it.
Right. I agree 100%. And one thing we haven't really mentioned yet is that even though interest rates are going up, even though the economy may go into a recession, no one knows for sure, houses going on the market seem to be picking up just a little bit. Mm-hmm. And the staying time for a house to get their offer is increasing 1 day, 2 days, just a little bit longer. So if that trend continues and we get back to just a normal market with more houses available, the deals will be out there. We're going to find the good deals. And if we're wanting to do the BRRRR strategy, there are always houses out there that some homeowner somewhere has trashed and brought the value down. But most of the trashing is cosmetic, where we can fix it back up.
Right. There will always be opportunities. So yeah, be positive, keep your head in the game. It's a storm we're going through, but we'll make it through to the other end and we'll be better for it. We're going to learn stuff along the way. I have confidence that I'm going to be able to keep buying properties. I know Mark, as always, is buying properties. So Mark, those are all the questions and thoughts I had for the day. It's up to you.
All right, sounds good. Sounds good. Well, you worded it correctly. You know, we're going through a storm. We're at the beginning stages of a storm, and you never know how that storm's going to play out. I'm older than Mike by what, 20 some years. I've been an investor since basically the day he was born, 1990. I've been through, and I was a stock investor, but I've been through market crashes, market drops, so on and so on. And even though I wasn't investing in real estate back then, I still saw what was happening with real estate at various times from 1990 to 2022. And I think I said in some video recently, even in 1990, there were real estate investors out there. In 1998, when we had the Great Recession, there were real estate investors buying properties. 2022, 2023, there will be real estate investors buying good deals. So the goal is that myself, you, everyone watching this video, that we can find those deals out there and just keep plugging forward.
Yes, sir.
All right. All right. Good enough. Well, unless you got any final words, I guess we can go ahead and wrap this up.
Sounds good to me, Mark. Thanks for always taking the time. And always, folks, if you're not following his channel, if you're watching but not subscribed, subscribe to his channel. Okay. You get daily content here. It's good content from a real investor who's not so big that it's not relatable. I mean, he's just an average guy who had a blue collar job. It's significantly more relatable than significantly more relatable than most people out there. So follow along for the journey, for him, for me. It's the best thing you could do if you actually want to make, inroads on investing in real estate.
Sounds good, Mike. Thanks so much. I appreciate it. So for Millennial Mike, this is Mazske Finance. We are signing out. So as always, stay safe in all you do. Take care, and we'll talk to you again soon.